Happy Friday, everyone. Thanks for joining us today on this edition of Business Daily. I'm Lee in Seoul. Before we get started, let's first get a quick check of today's highlights. With the United Arab Emirates investing more overseas, Korean businesses are looking to expand their presence in the region and find new growth engines. It's been a little over a week since Donald Trump grabbed his victory over in the U.S., and we take a look at how markets have reacted to the new president-elect and his policies. These stories and more coming right up. Korea's producer prices continue their upward trend for the third consecutive month in October, rising 0.2% compared to the previous month. Korea's central bank said preliminary data shows that producer price index has been on a steady rise since August. Coal and petroleum products shot up 6.4%, riding on the recent upswing in global oil prices. The index for the service sector, including restaurants and transportation, also edged up 0.1%. But agricultural and livestock goods dipped 5.4% compared to the previous month, as related businesses suffered due to the after effects of the intense summer heat wave. Korea's top central banker says he will take steps to protect the local financial market against volatility. During a meeting with the heads of local banks this morning, Bank of Korea Governor Lee Ju-yeol expressed concerns about the difficulty of predicting the impact of the new U.S. president-elect's policies on the market. The unexpected election results sent initial shockwaves throughout the global financial market, in part because of the uncertainties surrounding Donald Trump's policy proposals. The BOK governor said he is watching the markets closely more than ever before, and the central bank will act on any signs of market instability. And moving on to markets, to give us a wrap-up of this week's stock market action, we have our Business Daily's markets contributor, Choi Jin-sak, joining us on the phone today. Hello, Jin-sak.
Thanks for having me.
All right, so as we close the week, how are things looking on the last day of trading?
On Friday, the Kospi market fell slightly by 0.3% to close at 1974.58, while the Kosdaq followed with a more than 1% plummet to close at 620. Rising expectations of an imminent interest rate hike in the U.S. spooked overall sentiment in the Korean market. Following remarks from Fed Chair Yellen overnight in the U.S., foreigners and institutional investors unloaded massive amounts of shares. The Kospi index once fell below 1970, but foreigners shifted their position to buy, limiting a further slide. As global investors are expected to concentrate on large-cap stocks in the face of a U.S. rate hike, downward pressure on the Kosdaq market was even greater.
And we saw a mixed picture between advanced and emerging markets after the U.S. presidential election last week. So with that, how was the overall weekly performance?
On a weekly basis, both the Kospi and Kosdaq fell slightly, and as you mentioned, Donald Trump's victory sent mixed signals to global stock markets. After the election through Thursday, advanced markets have all enjoyed a decent rally. KTB Securities said the Japanese equity market has risen by 4%, the Dow in the U.S. by 2.9%, and the German market by 1.7% due to expectations that Trump will expand fiscal policy, triggering more inflation. But fears of trade protectionism spooked sentiment among emerging markets, with the MSCI Emerging Market Index plummeting more than 6% during the same period. On the Korean market, foreign investors sold massive amounts of shares on a weekly basis, reflecting such fears.
Now, for the upcoming week, experts say the focus is shifting to the Forex market.
That's right. The strengthening dollar in particular, along with Trump's victory, Fed Chair Yellen's testimony is expected to serve as a catalyst to lift the value of U.S. dollars further. This is not good news for emerging market currencies, including Korea. So investors will want to take a look at global economic indicators reported next week in the framework of currency movements. And of course, the FOMC minutes revealed on Wednesday local time will draw a lot of attention from investors in this regard. This has been Choi Jin-seok for Business Daily.
Hyundai Motor and sister company Kia Motors have seen their strongest sales figures yet in the European Union. The two companies combined grabbed a 6.3% of the market share in the regional bloc, which is the 8th largest in terms of size. According to the European Automobile Manufacturers Association, 12.3 million new cars were registered in the regional bloc this year as of October, a 7% increase on year. Among them, Hyundai Motors sold over 410,000 cars, an increase of almost 9% compared to last year, while Kia Motors saw sales jump nearly 14%. The economic relationship between Korea and the UAE goes back almost half a century, from trade in oil and construction to entrepreneurs setting up local businesses. Now it's set to diversify farther as both governments try to find new growth engines. Our Kwon Jang-ho reports from Dubai.
In the heart of the Dubai textiles market, or souk as it's known, is the office of a Korean businessman who's been importing textiles from Korea for over 10 years. But not just any textiles. Kwon Jang-seop has been importing fabrics exclusively for abayas, the black cloak worn by women in the Muslim world.
여기 결국은 좋아하는 게 얘들은 터치자, 이 터치가 실크고 드래프트, 그다음 안 감기는 거.
한국에서만 나오는 거예요?
지금 현재 한국 다른 데도 좀 쓰고는 있죠. 근데 이 정도까지 나오는 거는 지금 한국뿐입니다. 아직은.
Working with local sellers, he's also created a niche offering colored and patterned abayas that have proved to be a huge hit with customers.
Now they have faith in the Korean products. Initially they were a little bit afraid, but now since so many years they are using, and now they expect more of Korean fabrics rather than other country.
Textiles is one of many Korean import products in the UAE, including cars and electronics. But the crux of the bilateral trade relationship is based on fossil fuels and construction. Korea is the third largest importer of UAE oil, while Korean contractors have been involved in the UAE's major infrastructure projects. This is the Burj Khalifa. At 828 meters, it's the tallest building in the world, and it was built by Samsung. And it represents the peak of the construction partnership between Korea and the UAE. But increasing competition from China, as well as slowing industry growth, has led to fewer construction opportunities, and Korea is recognizing the need to diversify.
The UAE is increasingly investing outside of oil, gas, and such energy-related industries. Demand is increasing in industries such as healthcare, IT, and environment, and those present an opportunity for Korean businesses.
Seegen, a medical diagnosis company from Korea, is benefiting from the burgeoning healthcare sector. It set up in Dubai in 2014 and has found success with its Middle East respiratory syndrome detection kits.
The healthcare industry in the Middle East is the fastest growing market in the world. The UAE can be seen as the hub of the Middle East, and for Korea's healthcare industry to enter the Middle East and Africa, it's an important gateway to crack.
Korean businesses in the UAE are building a varied presence here, and as both economies change, the diversity of the projects is expected to increase, even as the relationship remains strong. Kwon Jang-ho, Business Daily, Dubai.
It's Friday, and that means it's time for a look through some of the important global business stories that made headlines this week. And for that, we're now joined by Ines Kim in the studio. Hello, Ines.
Hello.
All right, so U.S. Fed Chair Janet Yellen breaks her silence for the first time since Donald Trump was elected as the new U.S. president. And all indications now point to a rate hike in December.
That's right. Can you believe it? We are now less than a month away from the FOMC's final monetary policy meeting of the year. And if there was any doubt a rate rise could be postponed to next year, that it would come next month, Fed Chair Janet Yellen appears to have diminished that view. Take a look.
Chances of a U.S. Federal Reserve rate hike in December just edged up even closer to 100%, according to market watchers. This after America's central banker told a Congressional Joint Economic Committee that despite the great amount of uncertainty that's emanated from a Donald Trump election win, the FOMC sees a rate rise, quote, relatively soon.
At our meeting earlier this month, the committee judged that the case for an increase in the target range had continued to strengthen, and that such an increase could well become appropriate relatively soon if incoming data provides some further evidence of continued progress toward the committee's objectives.
She said the U.S. economy was nearing full employment. And while inflation has not quite reached the 2% target, it looks to be on its way there. Fresh U.S. Labor Department reports support this view. They showed that in October, consumer prices jumped by the most in 6 months, while first-time unemployment benefit applicants plummeted to a 43-year low through the end of last week. Chair Yellen made clear that she intends on finishing her 4-year term, despite Trump's past attacks as a candidate on the Fed and herself, also warning the incoming administration against excessive fiscal stimulus that could further drive up Washington's debt load, instead advising spending that would improve Americans' productivity.
My advice would be, as you consider fiscal policies, to keep in mind and look carefully at the impact those policies are likely to have on the economy's productive capacity, on productivity growth, and to the maximum extent possible, choose policies that would improve that long-run growth and productivity outlook.
So we're expecting a rather small increase, about 25 basis points from the current 0.25 to 0.5%. But what about next year? I mean, could we see even more rate hikes down the line?
Sure, and there had been concerns that liberal spending as well as lower taxes, both individual and corporate taxes, could have an inflationary effect under a Trump presidency and thus force the Fed to drive up rates faster than expected. Now, Chair Yellen did not number how many rate increases she sees in 2017, but did say the Fed would take into account decisions by the White House and Congress, both of which are led by the GOP, when it sets interest rates next year. Now, as noted earlier in stocks, we have seen a sizable capital flight out of emerging markets since Trump's election win last Wednesday. The MSCI Emerging Market Index, which tracks the market cap of indices in 23 emerging economies, including Korea, China, and Brazil, has struggled to recover since plummeting last Friday. We also saw investors pulling out of bonds, sending yields significantly beyond 2% as prices of the benchmark 10-year Treasury notes dropped, and that liquidity looked to be rushing over to U.S. stocks. The S&P 500 continued its strong rally this week, climbing within 4 points of an all-time high on Thursday.
And of course, the concern here in Korea is that a U.S. rate hike next month could prompt an outflow of foreign investments. So at this point, any forecasts on how emerging markets could do looking ahead to next year?
Sure, and this will, of course, heavily depend on what kind of policies we see rolled out under the Trump administration, which, of course, we won't know for sure until he is sworn into office on January 20th. But Goldman Sachs did issue a note to clients following Yellen's address on market themes for 2017. And on the topic of EM assets, it was relatively bullish, saying the so-called Trump tantrum on EM assets was temporary, and they don't expect it to be a theme into next year. Chief credit strategist Charles Himmelberg says it is their consistent finding that, quote, when stronger U.S. growth accompanies higher U.S. rates, EM assets can prosper, especially in equities and spreads. Goldman also adds it doesn't see a trade war ignited anytime soon. Instead, it believes trade pacts like the NAFTA will be renegotiated with a focus on improving U.S. manufacturing jobs.
All right, well, for now, we'll look ahead to the Fed meeting in December. Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching. We'll be back next week with more at the same time, same place for your Business Daily. Until then, goodbye.